Lale, it's been a phenomenally interesting 6 months, but what has stood out to you so far?
Look, if there is one theme defining 2025 so far, I would say it's policy uncertainty.
Last week, Texas allocates $10 million to buy Bitcoin reserve. It's the first state to buy Bitcoin.
Yeah, I think when you look at 2025, we saw volatility really cut both ways, both to the downside and then the very sharp rebound back to the upside.
Hello everyone and welcome to our latest quarterly investment outlook. We've called it Confidence and Caution. What is really moving the market? It's a pleasure to be your host today. My name is Sam North and we're going to discuss it all. And I look forward to doing that with our amazing analyst team. Just before we do get going, quick disclaimer, this is for marketing communication and not should be taken as investment advice, personal recommendation or an offer of or solicitation to buy or sell any financial instruments. If you're on the podcast and you want to follow along, do remember you can click the YouTube link. We're joined by three of the very best. We've got Lale, Akoner, our global market analyst. We've got Bret Kenwell, our US investment analyst, and we've got Javier, Molina, our Spanish market analyst and crypto expert. They're all waving at the screen right now. So if you are on the podcast, come and join us as we discuss the last 3 months and also look ahead to the next 3 months. Lale, it's been a phenomenally interesting 6 months, but what has stood out to you so far?
Thank you, Sam. Look, it's fair to say that 2025 has delivered anything but a uniform story. What we've seen so far is not a single dominant rally, but rather a series of sharp divergences that we're seeing across asset classes, geographies, and investor expectations. So let's first start with performance. Obviously, the standout winner year to date is gold, striking up like 29% in performance. That rally, as we know, has been driven largely by increased geopolitical risk, a weaker US dollar, and rising central bank demand. In a world where volatility has really become a permanent feature, we think that gold has reasserted itself as market's primary volatility hedge. Coming second, close behind, is Chinese equities, and we did call it in the past quarterly, with the MSCI China index gaining at around 15%. After obviously years of underperformance, investor sentiment is reversed thanks to a wave of targeted stimulus coming from Beijing, improved credit flows, and also signs of stabilization in the property and EV sectors. In Europe, indices are up around 6%, mostly supported by, I would say, easing inflation, energy transition tailwinds, and also better than expected earnings in industrials and financials. Meanwhile, Bitcoin is up around 5% on the year. Obviously, favorable supply dynamics and continued institutional ETF inflows have really made the demand resilient here. US markets, Sam, overall have lagged. The S&P 500 is barely positive. NASDAQ is essentially flat, I would say largely due to the weakness that we're seeing in the tech names. The so-called Mag 7 are around down by 4% this year, as investors are reassessing these lofty valuations and earnings momentum slowing after 2 years of outperformance. Obviously, further down the list, we have Japan, which is slightly negative. Private equity ETFs have dropped by 11%, and the US dollar is down by 9%, really for us underscoring the global rotation into real asset and non-dollar exposures. So looking ahead to Q3, the calendar is loaded with key events that could, in our opinion, reset the tone for markets. Obviously, the ECB is meeting on July 24th. We will look at any continuation in the easing cycle. Then we shift to the United States, where we will have Microsoft earnings report due. We have Apple coming up in July as well. In early August, we will hear from the Bank of England on the next policy decision. Then again, we have Amazon and Alphabet on their earnings as well. September could be decisive. We have again ECB meeting. The Fed follows on September 17th. And just after that, we will have the Q3 earnings season starting, which will really help us determine if this year's market rotation away from the US tech and into gold, China, and European cyclicals has further room to run, or if we will see a reversal. So to sum it up, Sam, 2025 has so far been a story of rotation, of repricing, and relative value. This performance dispersion is highlighting the importance of diversification, in our opinion, with gold, China, and European assets doing much of the heavy lifting, while the US tech is really posing to digest those high valuations. But as we enter Q3, macro policy and corporate earnings will take the center stage once again.
Thank you, Lale. And I guess it's worth saying for anyone listening to this or watching this that we're recording this about 3.5 days before the end of the first half of the year. So I'm asking the markets just have a few calm days. Nothing changed. Please. We'll wait and see, won't we, if that is the case. 2025 has been incredible for headlines. Let's now focus on for Q3 and those drivers, Lale. What's standing out for you at the moment?
Look, if there is one theme defining 2025 so far, I would say it's policy uncertainty. Nowhere is that more evident than that uneasy transition from monetary support to future fiscal leadership. So first one is corporate earnings and operating margins, in our opinion. They remain the primary market barometer. Treasury data show tariff receipts are up around 30% in the past 3 months, yet companies have largely absorbed that hit so far, keeping the headline CPI contained. Encouragingly, S&P 500 margins stopped sliding in second quarter and are now moving sideways. And history does tell us that when margins stabilize, equities can move higher, but the next 2 quarters of guidance, in our opinion, will be decisive. Next, tariff and tax policy obviously are the wild cards. The administration in the US's first 100 days agenda has produced a blizzard of proposals, but very little clarity on what the tariff policy will be like in the next few months, in the next few years, I would say. Tariffs are raising revenue again, yet the inflation pass-through remains muted only because companies seem to be eating costs, something that cannot, in our opinion, persist indefinitely. So Capitol Hill, on the other hand, is racing to sterilize those tariffs with a tax bill, but the House and Senate versions are diverging sharply, and some draft provisions are looking to be punitive for multinationals, especially European firms with large US revenue footprints. Meanwhile, Washington is pursuing a placeholder deal with several trading partners, but genuine trade clarity, again, may take far longer than the tax compromise that the Republicans will hope to land before July 4th. Until then, expect deal making and capex to be relatively subdued. Liquidity, in our opinion, therefore matters, and investors should favor high quality, high liquid names that can be sold quickly if volatility spikes. The third driver we look for, Sam, is obviously the monetary policy. The Fed is leading on that front. It doesn't want to move preemptively, it seems to us, while the data remain very fluid. Officials are keen to see how recent shocks, tariffs, geopolitics, and the oil rebound will filter through. The risk is obviously a data-dependent Fed lags and keeps policy restrictive for too long. We do have one underappreciated tailwind for the overall macroeconomic environment, and that's the long-delayed employee retention tax credit refunds that are finally being repaid to small businesses at an annualized pace of roughly 0.8% of GDP, really pumping cash into small businesses and laying the groundwork, we would say, for an unexpected growth pop in Q3. In the meantime, another driver is obviously crypto. It still enjoys structural tailwinds, in our opinion, but the next leg up will require, in our opinion, regulatory clarity on custody and taxation, as well as confirmation that the global rate cutting cycle is still underway. So Sam, to sum it up, taken together, we would say Q3 will hinge on 3 things. First, whether operating margins can hold the line against tariff pressure. Second, whether Congress can really deliver a workable tax deal that offsets those tariffs. And third, whether the Fed can pivot before slower data snowball into something more serious. Until we have answers to these questions, we think that the prudent stance is to stay diversified, keep a close eye on liquidity, and be ready to rotate quickly as policy headlines evolve.
Thank you, Lale. Let's get ready for those next 3 months. And for everyone on YouTube, drop a comment. Let us know what driver you think is most important here. And also let us know in the chat what you agree with, what you don't agree with. It'll be interesting to hear from you all. And actually, we did a survey recently, which we got over 1,000 responses, which is great. I love seeing what everyone is thinking. A couple of things stood out to me just going through the survey results when we compare the June poll to March. So for the best asset class performance in Q3, you can see stocks there has improved from 45% to 49%. Crypto's gone down a touch. I'm looking forward to hearing from Javi in a bit. Bonds as well dropped from 5% to 3%. In terms of regions that you guys at home listening to this expect to do well in Q3, the US has gone up a little bit after maybe a poor start to the year. People see a little bit of value there potentially. China's gone down. We mentioned China had a good start. Europe as well, also down a touch. The UK is up. Thank you everyone for having a little bit more confidence in my my home country. In terms of sectors, you can see not massive amounts of change there with tech, but we do see you guys at home thinking there will be a little bit of an outperformance there. Energy as well is up. And in terms of themes, you see disruptive tech there, the main increase going from 35% to 41%. Thank you everyone for getting involved in that survey. Bret, over to you now. It's never been a quiet 3 months when I come to you on this quarterly, and the last 3 months has been exactly that, has it?
No, Sam, and if you just look at your quarterly statements, it looks like quite a boring year, right? S&P is about flat, and NASDAQ just a tad below. But when you really strip back down to the day-to-day, the week-to-week, man, it's been a whirlwind 6 months to start the year. And that volatility is something we've seen very clearly in equities. The S&P 500 all but entered a technical bear market, and then a few months later, it's back in a technical bull market, those being defined by 20% declines and then an ensuing 20% rebound. But that volatility is really filtered all throughout different assets. We've seen volatility in the U.S. bond market, for instance, with the 10-year Treasury yield hitting its highest level since Q4 2023, which was a 13 or 14-year high at that point when it touched 5%. We've seen the volatility in the U.S. dollar, which hit a 3-year low. So it's really filtered. It hasn't just been contained to stocks. And I think that's a big takeaway for the first 6 months of this year. We've seen so much movement in different asset classes. And, now as Lale mentioned, with the Fed is sort of in this wait and see approach on how to handle their monetary policy, what they should do with interest rates, because they're waiting for that volatility to filter through the macro data, be it GDP, inflation, or the employment rate. So we're kind of waiting for the Fed, who is also kind of waiting to see how things shake out. And so that creates it creates a level of uncertainty, and that's not something markets generally like. Now, equities have done really well to rebound back up toward its prior highs that they hit in February. But, as we look forward to Q3 and even into Q4, it's really going to be a question, again, as Lale mentioned, what are these companies going to say when they start reporting earnings in July and August? And I think that's going to be an important tell, because as it appears now, when we look at consensus expectations, analysts expect really the bulk of the tariff impacts to hit in Q2 and then a little bit in Q3, and then start to kind of return to a bit of normalcy in Q4 and beyond. If the Q4 numbers and 2026 numbers become vulnerable to more impact, that's going to be a problem for equities. That's going to be a problem for investors trying to justify a valuation at or up near these record highs. And so we really need to hear a little bit of confidence and a little more clarity from management when we get earnings in a couple of weeks. But as we look forward, high single-digit growth for the S&P is the expectation for the year. generally speaking, those numbers tend to be a little bit of a low hurdle. So we'll see if we can have a little bit better of a response. And when it comes to the Fed, the expectation going into the meeting earlier this month was 2 cuts for the year. The Fed also gave an outlook where they expect about 2 cuts for the year. So that was in line with expectations. We'll see if they end up giving delivering on that front. But on the next slide, I kind of want to dig into a little bit more specifically around the earnings growth, that being led by tech this year. So this is the chart on the right. It's kind of an interesting breakdown of time frame. I don't know that I've ever measured a return from Q3 through Q1 of the next year. So July 1st, 2024 to March 31st of this year. But for my type of work, I really start at the top level, so the index level, and then go down to sectors, and then look for individual stocks within that space. But one thing that really stuck out to me in Q3 was how bad tech performed. It was the 10th best performer in the S&P 500. There's 11 sectors, so the other way to say it was the second worst performer when virtually every other sector gained in that quarter. And that stood out to me, considering so many of these names had rallied to record highs in June and July, and then they had this really poor ending to the summer, and they didn't do that great in Q4, and then in Q1 they were downright awful alongside consumer discretionary. So when we look, we see tech has really been a terrible performer over the last 3 quarters, which is significant considering A, tech makes up almost a third of the S&P 500 weighting, and B, it tends to be investors' favorite stocks. But it's interesting to me, markets tend to be forward-looking. We see tech really retook its leadership role in Q2. It's been the best performing sector so far, like you mentioned earlier, just a couple days left in the quarter, but it's got a pretty good lead on the second and third place finishers. But when we look for the full year, it's got the strongest earnings growth. When we look to 2026, it has the second strongest earnings growth expectation. So if tech can continue to build on the momentum that it's had this quarter, the risk being that this is just a momentary 1-quarter rally, and we kind of go back to the multi-quarter slump. But if it can continue to build on this momentum, that could be another big positive for equities moving forward.
Thank you, Bret. It's probably been the most interesting flat year to date I've ever seen. There's been a headline after headline after headline. So there's never a boring day in markets. 2025 has told us that. Lale, let's have a quick move over. Let's take the plane. Let's fly over to Europe and have a look what's going on over there. How are you seeing things at the moment?
Yes, obviously Europe remains one of the more compelling, but also more selective opportunities that we see in global markets at the moment. Easy monetary policy is giving way to a slower but still directionally easy policy path, right? So that's not the same as we would say outright tightening. Investors, therefore, in our opinion, need to reduce reliance on rate cut stories and instead focus on companies with really quality balance sheets and pricing power and real asset exposure. And those attributes, in our opinion, is actually plentiful in Europe, where forward price to earnings multiples still sit roughly 20 to 30% below US peers, offering obviously a valuable margin of safety still if policy stays higher for longer. What really sets apart Europe today, in our opinion, from the post-2010 austerity era is really the breadth of structural fiscal support, right? We have defense spending, we have energy transition outlays, and record digital infrastructure programs that are all acting, in our opinion, as secular growth drivers, independent of what the ECB decides to do in the next few months. And this is also visible, in our opinion, in Southern Europe, where Spain and Italy are benefiting from robust earnings momentum in banks and defense contractors, coupled with, in our opinion, still attractive valuations. Germany's defense beneficiaries have already re-rated sharply, so we're watching for rotation into the more cyclical and value-oriented sectors such as, say, banks and insurance. In our opinion, to extend the rally, we still need earnings upgrades when the Q2 earnings season starts in mid-July. Without fresh guidance, in our opinion, multiple expansion alone has limited headroom, right? Like the US, we will look to see how operating margins get affected from looming tariffs and obviously policy uncertainty. And again, management commentary in Q3 and Q4 will also be critical, especially, as I said before, given that supply chain costs are still in flux. Against this backdrop, our sector stances in terms of what we favor is banks, insurance, defense, healthcare. They remain our preferred stabilizers, again, supported by their solid balance sheets, pricing power, and those hefty fiscal headwinds that I talked to you about, tailwinds that I talked to you about. Tech and autos may lag, in our opinion, until we have greater clarity on tariffs and obviously the pace of global demand. So in our opinion, Sam, the key message is that Europe's story in 2025 is no longer just a monetary one. It's really a leadership reshuffle driven by valuation re-rating, the fiscal muscle, and sector rotation. So stay focused on quality names that can defend their margins and avoid overexposure to rate-dependent growth narratives, right? Should serve investors as the continent's policy and earnings picture continues to evolve.
Thank you, Lale. You mentioned Spain there, which gives me the perfect link to bringing in our Spanish analysts. And my second favourite Spaniard behind the Arsenal manager, Mikel Arteta. So Xavi, talk to us a little bit about how you're seeing Bitcoin at the moment, what you're looking at.
Yes, hi Sam. I think it's clear that something is changing and is moving fast. No, new actors are coming in. New regulation in Europe is already in place. Now we see that movement in the US, and what seemed impossible now is happening. So that's not just about price. It's about the future of value, and we are entering in a new phase. And these are the key points that I believe we need to watch closely. First, the strategic Bitcoin reserve. You know that the US government now has Bitcoin reserve, and what does it mean is that big investors are winning more confidence, and if more countries or institutional just the states, for instance, in the US are following, this is going to help Bitcoin growth even more. Just to give you an example, last week, Texas allocates $10 million to buy Bitcoin reserve. It's the first state to buy Bitcoin. So that's a point just to follow next month. Companies buying Bitcoin. Some companies are putting Bitcoin in their treasuries like they do with cash or with gold. They call the digital capital. And this could be a big signal for the market. But if they do because of the fear of missing out, this could be risky. But on the other side, last week, MicroStrategy, they add 250 Bitcoins. A luxury car company will buy $500 million to buy Bitcoin. Metaplanet in Japan, they just buy 1,100 Bitcoins more. They have something like 11,000 now. Chip market company, Sequence, launch a plan to buy 40, I think it's 45 Bitcoin, so $300 million. So there is a movement in this side. It's also interesting just to follow what's happening on the trading side, because what we see is today more than 75% of Bitcoin trading happens outside the blockchain. What does it mean? That ETFs, platforms are the ones that manage the money, the real money. So we have to check what's happening with this money moving from one side to the other. But I think that institutional money is entering in this kind of new vehicles. So the flows here are really interesting to understand what's happening here with price and with liquidity. And finally, I think it's interesting what's going on with the stable coins, because they are used more and more for real payments. They connect crypto with the real world. So they are helping crypto going mainstream. step by step. So this is important just to check what's going on in this new phase. No, if you go to the next slide and just to open a bit. And just to finish with Bitcoin and with the risk on assets, we have to check the global liquidity, because you know what, when central banks, they print money, the M2 grows, Bitcoin used to go up. So if we see more liquidity in the system, the Bitcoin bull, the bull cycle could come back. Just to give you the final data that I'm just checking, global money supply has increased around 6.7 trillions in 2025 already. So this is more gasoline. This is more money flowing into risk assets and of course in Bitcoin. If we see the rest of the ecosystem, I think that Ethereum is changing. It's no longer just for speculation. Big investors, active users, and the rise of the ETFs are turning Ethereum into a base for a real finance where the actual system is building yield strategies and real world apps. Just to give you the final data for June, for instance, 30 million of active address are just working with Ethereum, and they are building all the tokenized, the real world assets are building. If you check on the graph here, so it's like 80% of this tokenized new system. We're talking about stocks, we are talking about bonds, we are talking about mutual funds. They are moving, or they are trying to connect with the blockchain system in order to win liquidity, transparency, and this is important for Ethereum. So I think that we have to have a look at what's going on these real world assets. And just to finish, some comments on Solana and Ripple, because we expect, I think that it could be during the rest of the year, the first ETFs on Solana and on Ripple. So this, if they get approved, it could bring new money into crypto. So watch how regulator responds. They will shape the future of adoption if this is going to happen. Just to give you another name, I really like it, is Base, the network, because they are all-time high in terms of users activity, utility. JP Morgan deposit token is Base blockchain use, so they are launching in the Base blockchain. So a lot of things are happening here, and what does it mean, as I said before, is adoption. So now it's real, but it's not just for speculation, it's for real use cases as the tokenized new finance. So these are the key points, Sam, that I think that we have to watch just to understand the flows and what's happening, why Bitcoin is in the loop now, and the rest of the ecosystem. But just when you have utility, that's the key points that I think is interesting to follow next month.
Thank you very much, Javi. Some really interesting points there that I'm sure people will be keeping an eye on now. And actually, let me know in the chat on YouTube, let us know your thoughts on crypto at the moment and Bitcoin in general. I'm actually just going to have a quick look at the chart here. So again, if you're on the podcast, do pop over. I think a couple of things of note is just how well it's held up in recent weeks and months. For me, has been impressive with all the volatility that we've seen elsewhere, the news headlines that we've seen elsewhere. So that for me gives me confidence actually that we can continue to push higher under the right circumstance. Our blue line here is the 50-day moving average, and you can just see how well it's respected since we broke above there back in late or early 2023, where it had been resistance before. I mean, just look at this chart, how well it has respected that level. And I'm not saying Bitcoin is going to move lower, but if it was, just keep an eye on that level, and it may well also coincide with 88,000, which was resistance earlier this year. That would be something to keep an eye on. Also, it is worth noting as well, since we made an all-time high at the back end of last year, we've had a few times here, sorry, this is our weekly chart, not daily, where we tried to get back above that, and we just can't. So I'd like to see a weekly close above the all-time highs, and that would give people a little bit of confidence. We finally closed at a new all-time high. Okay, let's push on. So that would be something that I'd be looking for as well, and I believe other technical analysts would do. Obviously, the scenarios need to be right for that, but that would be an area I keep a watch on. And certainly in the short term, 97,000, a key level of what was support previously was resistance as well. So those would be areas of the market I think that are worth keeping a watch on. And for everyone in the chat, let me know, do you agree, do you disagree? Let me know how you are seeing this chart. Javi and Bret will be coming back to you very shortly for our Q&A, which our wonderful listeners have sent in for you all. But before we get to that point, and let me remove my annotations, we don't want that all on the chart. Lale, let's talk about the 2025 investment outlook.
Thank you, Sam. Look, when we look at the third quarter, we think that investors need to have diversification, rotation, and selective hedging, right? So the macro backdrop still points towards a more moderate global growth, easing but not collapsing inflation, and again, a gentle drift toward lower policy rates. So that mix, in our opinion, supports risk assets, yet it also rewards investors who balance a pro-risk stance with, say, enough hedges to navigate those spikes in volatility that we've seen in the first half, but we think we will continue to see in the second half as well. The good thing to note is that obviously a vast pool of idle cash is still remaining on the sidelines. And as central banks pause and eventually start their easing cycle again, we think that liquidity is going to be redeployed, not indiscriminately, but selectively. In terms of the overall equity markets, we are looking for three bullish catalysts, which include first, a restart of the Fed's cutting cycle, second, meaningful progress on global trade agreements, and third, obviously, a clarity around the administration's tax agenda. Until those fall into place, we think liquidity is at a premium, and investors should emphasize balance sheet strength that I've talked to you about in the past few slides, obviously margin resilience and the ability to exit positions cleanly, I would say, during bouts of volatility. As I said, equities remain the core allocation. We continue to prefer selectively Europe and US value shares, where valuations remain significantly below US growth counterparts. Sector composition in these markets favor, in our opinion, financials, healthcare, energy, those sectors that are benefiting from reflation and policy tailwinds, while also being less sensitive to interest rates than, say, long duration tech. Within financials, we especially like regional banks and insurance companies. These businesses are domestically focused. They generate income from lending and premiums, and they're relatively insulated from trade disruptions and FX volatility. They also benefit from stable net interest margins and floating income, particularly in this rate cycle and slower cut environments as well. Biotech and medical technology also stand out. These are innovation-led sectors that are driven by IP and pricing power, and again, which are relatively insulated from global trade flows. We also favor high-quality mid-caps and domestically focused small caps. We don't think a major recession is in the cards in the US. So we are looking, and as I said, the easy policy cycle will help these small caps in the next few months. Obviously, they have a reliable cash flow. They can defend earnings if growth does indeed slow down. And broadly speaking, obviously, we prefer service-based businesses from healthcare to software, looking far better position than, say, goods producers in a world grappling with, obviously, tariffs and reshoring. Outside equities, real assets, in our opinion, carry growing appeal. We maintain a favorable view on gold as a hedge against volatility and elevated geopolitical risk. And we also like broader commodities as a protection against, again, that supply side inflationary pressures. In our opinion, treasuries and high quality corporate bonds regain relevance once rate cuts begin, particularly in the short end, the belly of the curve, while tips also offer an elegant way, I would say, to hedge inflation surprises. Finally, we are mindful of what to avoid. Again, sectors heavily exposed to global supply chains like export-oriented autos, commodity-sensitive exporters, low-margin consumer goods. They remain, in our opinion, vulnerable to both tariff risks and I would say also FX-driven margin compression. In our opinion, finally, in this regime, we think that those businesses with localized revenue, pricing power, and strong balance sheets, and not just the global reach for its own sake, will continue to benefit.
Thank you, Lale. And now for my favorite part of the webinar. I've got a few questions which have been sent in to me from various different channels. The rules and regulations are you've got 1 minute, everyone, to answer these. Bret, I'm going to come to you first, and I'll go to you, Javier, and then Lale, and we'll go another round as well. Bret, first question then. 6 months into 2025, how should investors now think about diversification?
Yeah, I think when you look at 2025, we saw volatility really cut both ways, both, to the downside and then the very sharp rebound back to the upside. But I think what the first half really served as was a good reminder of how well a diversified portfolio can not only protect you from some of that volatility, but actually be a major beneficiary towards your returns. Of course, diversified portfolios don't always do that, but when you look at, from the perspective of the US, many investors are invested in the S&P 500. When you look at how well international stocks have done, how quickly Bitcoin moved back to all-time highs, what a phenomenal year it's been so far for gold. A lot of these assets, I think, it just serves as a great reminder to, look around a little bit and consider allocations into a couple different baskets.
Lovely. And all under 1 minute as well. Thank you very much for that, Bret. Javier, I've got a question for you, it was a common question, this one, and I want to know the answer as well. Will we get an alt season?
I don't think so. I think it has no sense to take risk in this part of the market, Sam. The focus is on Bitcoin. It's fighting to become the global digital store of value, and that's the main narrative today. Also, retail investors they are not here yet. We are not in a moment like in 2020, 21, where we saw all the Cardanos, Polkadots exploding. In fact, if you check, for instance, Polkadot, it has between 7 and 10% annual inflection. So, and they have no supply cap. So you have an inflationary token. I think it has no sense because interest and also the volume. If you check now, trading, 90% of the total volume is coming from the institutional side. So I think that is not a time. For sure that you can find excellent projects, small projects with utility, with users on artificial intelligence, for instance, on the agents, for sure, but it's not a time just in a diversified portfolio to add this kind of altcoins. Of course, Ethereum, they can have a role as a diversifier between your Bitcoin and your Ethereum or your Solana. L1 networks is okay, but just with a small portion of your part dedicated to digital assets. So I think that we are not going to see this altcoin season. At this moment, I don't know in 3 months if we're going to change, if the retail investor is coming again and we see different risk-on approaches. But now is not the time.
Thank you. Yeah, very good answer. And I'll let you off that it was just over 1 minute. I think it was an answer that was very needed. Lale, your first of 2 questions that will come to you after this as well. Is the recent dollar weakness just a short-term move, or is it start of something bigger?
It's a great question. We get that a lot from our clients as well. Look, there have been short-term catalysts, like, say, a soft US data, obviously rising tariffs, and the Fed rate cut expectations that have pressured the dollar. But we think that there is a more important structural story underlying this as well, which might stay here for longer. And that's a structural shift in global reserve preferences. Obviously, for decades, a weaker dollar would trigger foreign central bank demand for treasuries. But that pattern now is breaking. Instead, we are seeing a continued selling of US debt and actually a growing preference for gold and non-dollar assets. In fact, a recent World Gold Cluster survey found that 73% of central banks are now expecting their dollar reserves to decline, and 95% of them are planning to increase their gold holdings. So this suggests, Sam, that current dollar drift could be the early phase of a broader, I would say, reserve realignment that would put pressure on the US dollar.
Thank you, Lale. And Bret, your last question of quarter two as we head into quarter three. Should investors be all in on tech going into the second half of the year?
Well, we just had the slide on tech, and as compelling as it can sound when you start to look at the earnings growth and the couple quarters of underperformance, helping take a little of that valuation pressure off, going all in on anything can be a dangerous endeavor. And I think all we have to do is point to the last several quarters of how poorly tech had performed to sort of underscore that point. And even if you zoomed out more broadly to the S&P, that has lagged a lot of its international peers this year. So I think it really kind of circles back to that point of diversification, and it's okay to have a conviction mindset towards certain assets, or whether it be it sectors or different, if it's precious metals or what have you. But going all in is always a sort of a dangerous method in investing. It generally is safer to have a wider lensed approach.
Yeah, well said. Well said. Javier, your last question of quarter two, and I like this one. Are we in a FOMO moment with all the buzz around Bitcoin treasuries?
So yes, Sam, I think that there is a fear of missing out in companies, and this is dangerous because if they buy Bitcoin with available cash, then it's okay, it's fine, they can manage volatility. But if a company use debt or complex financial products, structured products to buy Bitcoin, and the price goes down hard, we could see serious problems. So never buy those company stocks, buy the real asset instead, if you really understand the value proposals on Bitcoin in this case. And like it happened in 2021 when we had the NFTs, in 2017 where we had the ICOs boom, then perhaps this is the 2025 boom that we can see on the Bitcoin price, and so that's dangerous, and we have to follow it.
Thank you. And Lale, your last question of the first half of the year, but also this presentation's last question. What structural trends are shaping market leadership in 2025, and how should investors position for them?
I think I would answer 2025 and beyond. The first one would be a clear shift in the search for a demand in alternative energy, right? So that is coming from obviously EV adoption, AI infrastructure, crypto mining, all pointing towards a surge in electricity demand, nuclear energy, grid modernization, battery innovation. These have been sectors that have long been seen as niche, but now they're actually becoming, I would say, central to industrial policy and also energy security. At the same time, we are looking at tech, obviously, but the focus has shifted beyond mega cap AI names, in my opinion, to software, cloud, and digital infrastructure firms that are offering stable and recurring revenue without really the direct exposure, I would say, to supply chains or the volatility that we're seeing in the US dollar as well. On that, again, we like biotech and medtech. In our opinion, they are offering innovation-driven upside, but with minimal, again, geopolitical risk, and I'm talking about tariffs here. On the flip side, I would say the overstretched AI giants and highly leveraged firms, in my opinion, could struggle if rates remain elevated. So that's why we're saying, look, diversification remains key, blend quality equity names with alternatives, as Javi just talked about, like crypto or gold, to manage risk and also capture these emerging secular tailwinds, I would say.
Thank you. And that, as they say, is that if you made it this far and you haven't liked it, what are you doing? Give us a like, give us a share, give us a subscribe. And do remember, you can head over to Digest and Invest in the eToro Academy to find out loads more as well. But from me, thank you very much. From Lale, from Bret and Javi, thank you very much for joining as well, everyone. And we'll see you on the next episode.